All right, let's talk about Smith Wesson, ticker SWBI. The stock just had a massive pop following their latest earnings call, and we are going to dig in and figure out what exactly sent the stock flying. And when I say massive, I mean it. The stock rocketed up an incredible 23% in just one day. So what on earth was in that report? Let's dive into the details that lit a fire under this stock. So here's our game plan. First, we'll hit the headline numbers. Then we'll look at management strategy. After that, we'll break down exactly why the market went nuts, and we'll wrap it all up with our own rating on the stock going forward. Okay, let's get right into the numbers. And this is where it gets really interesting, because what we have here is a classic tale of two lines, the top line and the bottom line telling very different stories. So first up is revenue. It came in at about $124.7 million. Now, that was just a little bit ahead of what analysts were expecting, but it's still down almost 4% from this time last year. So not exactly a blockbuster number on the sales front. But here's where the story completely flips. The bottom line. Their adjusted earnings per share came in at 4 cents. Now, Wall Street was only expecting 2 cents. That is a 100% beat. They literally doubled expectations. That's what got everyone's attention. So you see the disconnect here. Sales were a little soft, but profitability absolutely crushed it. And this is the key takeaway. The market looked right past that small revenue dip and focused like a laser on how well the company managed its profits. So the big question is, how did they do it? How did they pull off such a huge earnings beat? Well, it all came down to focusing on what they could control. This was all about execution. And it really all starts with innovation. Get this. New products now make up almost 40% of their total sales. Think about that. This isn't just about selling more stuff, it's about selling new, exciting products that can command better prices. This wasn't luck. They had a clear 4-step playbook. 1, push innovation hard. 2, keep a super tight grip on inventory, which they cut by $13 million. 3, generate a ton of cash, over $27 million. And 4, keep costs in check. It's just a masterclass in financial discipline. And hey, you don't have to take my word for it. The CEO, Mark Smith, he spelled it out on the call. He said their new products were the significant catalyst. That's the engine driving this whole train. And here's the proof in the pudding. All that innovation gives them serious pricing power. Their average selling prices, the ASPs, were up across the board. And just look at that long gun number, up over 10% from last year. That's huge. It means customers are willing to pay more for their products. Okay, so let's piece this all together. Why did the market cheer so loudly? Because when you connect the dots, you see a really compelling bull case starting to emerge for this company. Investors put it all together. The massive earnings beat, the strong cash flow, the clean inventory, the rising prices. But honestly, the real kicker, the thing that sent this stock into orbit, was what management said about the future. And here it is. This was the mic drop moment of the call. Management came out and said they expect sales to actually grow by 8 to 10% in the next quarter. This wasn't just about one good quarter. This was a signal that a major positive turn is happening right now. So after a crazy 23% jump, where does the stock go from here? What's the right call? Okay, let's put on our analyst hats and break down our rating and our thesis. This is the big question on every investor's mind right now. Was this just a one-time pop, or is this the start of a longer, sustainable run for the stock? Is there more gas left in the tank? Our take? We think there is. We're initiating coverage with an outperform rating. Our outperform thesis really comes down to 4 key things. First, we see profits continuing to expand. Second, that innovation pipeline is a real competitive advantage. Third, their inventory is lean and clean, meaning no need for big discounts. And fourth, the data shows they are flat out taking market share from their competitors. Now, just for a tactical idea here, after a huge move like this, options can get pricey. So instead of just buying the stock, a strategy like a bullish call spread might make sense. It's basically a way to bet on the stock continuing to go up, but in a way that limits your risk. You cap your cost, you know your max loss up front, but you still get to participate in the upside. And finally, as always, just a quick reminder that this explainer is for informational purposes only. It is not financial advice.